Thank you for having me. It's great to be here, and I hope I can bring some good news for dry bulk and oil tanker shipping. So the main takeaways is that a prolonged period of underinvestment could lead, we believe that it could lead this decade to be one of the best ones in a long time. For dry bulk, we see strong fundamentals, a record low order book, and further upside ahead. For oil tankers, we see improving fundamentals. There as well, the order book is record low, and we believe we could see our oil tanker share index up by around 86% by the year end of 2024. So I'm just going to jump straight into it, I guess. This chart shows new build contracting from the year 2000 until today in US dollar billion, adjusted for inflation. So you can see that since 2016, I guess around here, you have a sustained period of underinvestment in dry bulkers and oil tankers. So this includes all vessels in the fleet above the thresholds I've put up here. And also you can see that the boom in container LNG shipping has caused massive uptick in new build contracting for these two segments the last couple of years. So there are many theories to why we don't order, or why firms don't order ships anymore. Some say it's because new building prices are too high. But actually, I'm not so sure that's really the case, because we have again adjusted for inflation. So you can see the blue line, which is new build prices for VLCCs for the last 25 years or so. We're here now, and that's close to an all-time low. Here a couple of years ago was the all-time low. So of course prices for steel is up, and other costs are up associated with supply chains disruptions and stuff like that. You can also see that the 5-year-old values are close to an all-time low, adjusted for inflation. I believe a larger reason why there's no ordering is technological risk. Okay, it was there. There are simply no viable green fuel options for deep sea shipping at the moment. LNG is of course better in CO2 emissions, but it has a worse methane slip, whereas green ammonia is years away from being commercially ready. Now, even if you wanted to contract new builds, the problem is that yard space is very constrained. So this is a bit of a technical chart, so maybe bear with me. Here I have taken all the vessels again, which above these thresholds, and calculated their compensated gross tonnage. Then I've aggregated all the vessels in the world fleet, and I've sorted it by years for delivery. And this line shows the median. So this tells us something about yard capacity and how much they have filled up their order books and delivery schedules year for year. So we see that in 2022 they had a bit spare capacity for deliveries, but 2023 looks to be well sold out, and 2024 appears to be close to sold out. Now if I deep dive into the data, I could find that where there are appears to be limited capacity is mainly at Japanese yards. I could sort it by looking at builders of VLCCs for the period, and they have no space left. Same for Capesize or oil tankers. So the only yards that have capacity, if I calculate this method, is builders of dry bulks in the period, and I can find space for around 75 Panamax equivalents in 2024, and that's it. So of course this is not a perfect method, but it gives us an indication that it's very constrained capacity on the supply side in general. Now I'd like to move on to the dry bulk demand side. So we believe that there's seasonal tailwinds ahead. China has been an issue, particularly for larger vessels, so far this year. I believe steel production was down 5% approximately year over year for the first quarter. The same was Brazilian iron ore export, was down 10% for the first quarter year over year. But the guidance for GDP growth, or China's GDP growth target, remains 5.5% for the year. They haven't adjusted it down. And the Vale's production guidance and export guidance also remains the same. So if we're going to see them reach these trajectories, 3Q and 4Q of this year could be very tight. We also looked at the conflict in Russia and Ukraine and believe that for coal, it could be a positive effect this year, whereas for grains, it could be a negative effect because we believe a lot of the lost exports from Ukraine will be lost demand because we don't really see anyone producing all that grains elsewhere. So adding it all up, also as I mentioned, the order book is record low. I believe it's around 6.4%, 6.3% at the moment, relative to the fleet. And we have records going back to 1996, and this is the lowest on record. So if I add this up and plug these inputs into my model, I get high or hovering around 90% utilization for the next 3 years. And this is using quite conservative inputs for delivery and scrapping. I believe I have allowed for 34 million deadweight tons of dry bulk deliveries in 2024. With at this point, it's only ordered 12 million. So the delta here of 22 million, that equates to roughly 300 Panamax equivalents. And as I said earlier, I see space for 75. I've also only allowed for, I think it's maybe somewhere between 12 and 15 million deadweight tons of scrapping in total throughout 2024. And we also have in the coming period, we have the hard deadline for ballast water treatment systems in 2024, where a lot of ships need to take investments, a lot of older tonnage. The same with the EEXI, and even worse with the CII. So if we look at the relation between these utilization levels, I think second half of this, or third, fourth quarter of 2023, we believe we can see 5-year-old Capesize values in the high 50s. And that would, if you look at the historical relationship between 5-year-old values and dry bulk share indexes, which have a very high correlation, that could imply a growth in our share index by 38% over the next year or so. Okay, so let's move on to the oil tanker segment. EIA is projecting that demand in energy growth across this decade will be around 104 quadrillion British thermal units. So in order the majority of that growth will happen in China, India, and developing Asian economies. To support that growth, I believe it's around 65% of that growth. To support that growth, the world still needs oil and gas. The green shift, as you can see here, is happening. They're adding every year, but the increase in crude and liquids production and demand will also increase across the decade. Again, most of it is driven by non-OSD Asia, where we expect, or EIA projects, that they will have an increase in demand of approximately 10 million barrels per day over the next decade. The only problem is they won't increase production. These are the crude oil production in the same countries, which is essentially flat. So the production will need to come from elsewhere. Some of it will come from the US probably, but the majority from Middle East. And of course that needs to be shipped. So that could potentially be a major driver across the decade. In the near term, especially for the crude tanker segment, we are still not very optimistic. By that I mean the next quarter, but we believe the fourth quarter this year might be good. The problem is that we're just not seeing enough tonnage supplied. So we are balancing and we are nearing pre-COVID levels in terms of supply of demand. The problem is that if you look at what's happened to the fleet, and we believe also that we will reach pre-pandemic levels in the fourth quarter of this year with oil production or supply. But the problem is that since then the fleet has grown by 40 million deadweight tons. So you don't get the same supply-demand dynamics in the shipping space, which obviously leads to lower utilization. But we are seeing light at the end of the tunnel. The US is grabbing market shares, which is positive for ton-mile demand, of course. The US production is nearing pre-pandemic levels, and the US exports of crude oil were at an all-time high in March. We're still seeing that OPEC Plus is lagging their production targets, and we really don't. They also have a target with 400,000 barrels extra by September, which we really don't believe. But anyway, we believe we are past the trough and that we are heading up. And also, what's happening now is that the crude and liquid fuels inventories are extremely low. So we're around here now, and the last time we were this low, we got a restocking cycle that lasted for 2.5 years. And if the same thing's going to happen now, which we believe, the world needs to restock their inventories and also fill up the strategic reserves, that could be a massive boost for demand going forward. The same for this segment. We see a record low order book. I think we need to go back to 1996 to see the same numbers in relative terms. It's currently hovering around 8.5%. And the year 2000, if we're looking at absolute terms. Since then, the fleet has more than doubled. So that's extremely low. So if you plug these inputs into our model, we get a slight dip in utilization. It looks worse than it is because I've rounded it to make it look nicer. I believe around 84 or marginally worse next year than this year. And it's mainly this quarter that's driving it, the second quarter because of the disruptions in Ukraine and Russia. But we believe that by the end of 2024 we can approach 89% utilization in the oil tanker space. Again, that would imply 5-year-old VLCC values approaching 100 million, based on like historical correlations. If we plug that into our share index model, we could potentially see our oil tanker share index rise by 86% by the year end of 2024. So we definitely believe that this is the time to position yourself in the oil tanker space. Also, you can see here where we are at our NAV and share index for dry bulk and oil tankers. So I believe we hosted a webinar around, I don't speak, but yeah, so this is probably February of 2021, where we said, okay, this is dry bulk. So we hosted the dry bulk webinar where we said that we believe we're going to see a massive upside over the next year. And since then, the share and NAV index has gone up by, yeah, you can see the slide. Now we believe we might see some of the same effects in the oil tanker space. So this is just underlying what I'm saying. We believe that this across the next 6 months to maybe a year is the time to position yourself. Okay, so I'm gonna just end by giving you some of our top picks. We cover a lot of equities. In addition to dry bulk and oil tankers, we also cover LNG and LPG shipping. So for the dry bulk space, I think my favorite stocks at the moment are 2020 bulkers. They have a really modern fleet of Newcastlemaxes, and the same could be said about Okeanis in the oil tanker space, which has modern VLCCs and Suezmaxes. I also like to do a small ad for my former colleague Joachim Hannesdal, and the Cleaves shipping fund that started up in October and has had 61% compound annual growth rate since then. So this is perhaps a good opportunity. He's going to launch an international tranche in May or June, I believe. Right now it's a Norwegian structure only, but this could be a great opportunity to invest in the shipping space if you're not already. So again, to recap, we believe that the prolonged period of underinvestment could lead this to be one of the best decades for shipping in a long time. For dry bulk, we see very strong fundamentals, a record low order book, and further upside ahead. And for oil tankers, we believe in very improving market conditions going forward. So that's it for me. And you can sign up if you'd like to read our research. You can sign up at cleaves.no. It's free of charge. And when we publish weekly reports and company reports and segment reports and other stuff like that. So thank you.